In 1967, US government bond yields witnessed an absolutely spectacular rise from 4% to 16% by 1980. And the same event that caused these rising bond yields following 1967 has also just happened today. Government bond yields have an absolutely massive impact on the economy and markets. They influence all other interest rates around the economy. That includes, for example, interest rates on corporate debt, so how much it costs for companies to borrow, but also the interest rates on house mortgages, so influencing how much it costs for you to buy a home. Back then, these rising government bond yields was the direct cause for multiple severe economic recessions that occurred in the 1970s and 1980s. In fact, if we overlay the S&P 500, the US stock market, on top, we see it experienced multiple severe declines that coincided precisely with the moments that bond yields rose. If bond yields were to rise today like they did following 1967, it would undoubtedly have similar economic consequences and a similar impact on the market. If we overlay the trajectory of bond yields from that period onto today, we do see a resemblance. But as I mentioned earlier, something happened right here in 1967 that caused these bond yields to really begin surging higher. Part of the story lies in what the Federal Reserve, the US central bank, was doing back in 1967 that is strikingly similar to what they've been doing today. This is what the Federal Reserve's interest rate looked like in the 1960s. Between 1965 and 1967, they raised their interest rate from 3% all the way to 6%. Now, historically, every time that the Federal Reserve raises their interest rate like this, it's been followed by an economic recession, as you can see from these gray recession bars. But not in 1967. If we look at the US unemployment rate during that period, it ticked up slightly, but then quickly came back down as the US economy avoided a recession. Again, you can see typically during actual economic recessions, the US unemployment rate rises. Today, we've seen something very similar happen. The Federal Reserve hiked their interest rate aggressively in 2022, but the US economy never actually experienced a recession. The unemployment rate ticked up slightly, but seems to already be turning lower. No recession has occurred as a result of the rate hikes, just like in 1967. This is what's known as a soft landing. It's when the Federal Reserve raises their interest rate, which typically causes a recession, but in the case of a soft landing, the Federal Reserve is able to lower interest rates back down without ever seeing a recession. This is something that historically is very rare. So that's the first similarity between 1967 and 2025. Both of these dates mark soft landings. But of course, there's more. Both of these soft landings occurred during a period where government spending was elevated. This chart here shows us how much government spending is growing over time. And over the course of the last 5 years, the government spending has been growing at one of the fastest rates of the last 70 years, comparable only to the peaks in government spending we saw right after the 2008 financial crisis and in the late 1960s. Many experts point to this high level of government spending in the 1960s as the fuel for the high levels of inflation of the 1970s. Indeed, we can look at what happened to inflation following 1967. It began to rise substantially just in the couple of years after, and actually marked the beginning of multiple waves of higher inflation, which was the primary cause for why government bond yields rose in the 1970s. As you can see, the more aggressive rise in bond yields occurred at the same time as the inflation rate in the United States picked up. So at a first glance, it might look like we're about to experience multiple waves of higher inflation in the United States, just like we did following 1967. But despite the two key similarities, we don't believe that we're going to be seeing high levels of inflation today. We actually think that inflation could continue to stay very low. And there's a couple of reasons for that. And the reason for that is because today's economy is actually much weaker than it was in the 1960s. And this chart shows us exactly that. It shows us the personal savings rate of US consumers over time. In the 1960s, consumers had a lot more money in the bank. Personal savings rate back then was about 12%, the highest levels of the last 60 years. So consumers could actually afford higher prices back then. If we look at the personal savings rate over the last few years, it's averaging about 4%, which is 3 times less savings than back in the 1970s. So today we have a structurally weaker US consumer. If you're saving 12% of your income per year, it probably means that you have some leeway to increase your spending if you want to or if you need to, and that can cause inflation. If you're only able to save 4% of your income, that's already a much thinner margin, and it's unlikely that you're going to be going on some big spending spree anytime soon. In fact, if we overlay the personal savings rate against against the inflation rate in the US, we see there's an extremely tight relationship between the two. Today's very weak consumer tells us that inflation is more likely to stay low rather than pick up. The only way that we see inflation picking back up in a big way is if the government decides to inject trillions of dollars in stimulus, which would make the savings rate go up and potentially lead to higher levels of inflation. This is exactly what happened following COVID, for example, where huge amounts of stimulus made the personal savings go up and fueled the high levels of inflation that followed. Today, although government spending is high, we're not really seeing that lead to a stronger consumer today. So we have a similar soft landing, a similar level of government spending to 1967, but we have a much weaker consumer in 2025 that is likely to keep inflation low. And that brings us to our final comparison between today and 1967, and that is the level of government debt. This was not something that was present in 1967 and is something that could make things very ugly today. The United States government has been running a steep deficit since 2008, and even more so since COVID. The US is bleeding about $500 billion per quarter. Naturally, we've seen government debt levels skyrocket as a result, and when we overlay US GDP on top of debt, we see that debt levels have surpassed GDP levels. So the ratio between debt and US GDP now stands at 120%, or in other words, debt is 120% the size of US GDP. Back in the 1960s, government debt was only about 30% of GDP. Given that the US government taxes GDP in order to pay its debts, a higher debt to GDP ratio questions the government's ability to pay back its debts. And so naturally, this raises the question of whether US Treasury bonds are truly as risk-free as they've long been perceived. If all of a sudden investors believe that US Treasury debt carries more risk, they'll demand a higher yield to compensate for that risk. So in other words, it would make government bond yields rise. Multiple independent institutions have studied the impact of the debt to GDP ratio on interest rates, and the consensus is that for every 1% increase in the debt to GDP ratio, you have a long-term bond yield that's 4 basis points higher. So with debt to GDP today about 100% higher than it was in the 1960s, one could say that bond yields should be about 400 basis points higher than they were back then, or in other words, 4%. If we come back to our chart of government bond yields, if these were to be 4% higher, it could take government bond yields all the way up to 9%. And the worst thing is, inflation doesn't even need to move up for that to happen, but it would still very likely cause extreme market and economic volatility. Now, this is a long-term theme that we think could drag government bond yields higher over the next 5 to 10 years as investors increasingly question the US government's budget. In the short term, however, so the next 12 months, we're not too worried about that as bond yields have already suffered from a huge rise over the last few years and financial markets are adjusting to this new reality. So we believe that over the next decade, higher government bond yields are going to create significant market and economic uncertainty unless the government is able to get its budget under control. For now, however, this bull market in stocks has been driven by lower levels of inflation. And as we highlighted earlier, we think inflation is going to be staying low over the next year because of a structurally weaker consumer. The theme over the last couple of years has been that the average person is getting poorer while financial assets like the stock market, gold, crypto have been skyrocketing higher. Although it's not a pretty picture, we think this theme is going to continue in 2025. And as they say, if you can't fight them, then join them. This is why we're strongly pushing for people to be invested in financial assets to hedge themselves against rising wealth inequalities. We've been benefiting from this bull market in financial assets over the last year. If you want to do that with us in 2025, go and check out our service. You will not regret it.